Gold has fascinated humanity for thousands of years. It is not just a shiny yellow metal, it has been a store of value for civilizations long gone. Kings and queens hoarded gold. Empires were built on its allure. People instinctively understand its worth. Gold's history as money is long and proven. It has outlasted every paper currency ever created by governments. It represents true, lasting wealth. Why is gold still so popular in our modern world? Look around you. Governments are printing money like never before. This devalues the paper currency in your pocket. Inflation is a hidden tax on your savings. Gold, on the other hand, cannot be printed into existence. Its supply is limited by nature. This makes it an excellent hedge against rising prices. As currencies lose their purchasing power, gold tends to hold its value or even increase. We live in uncertain times. Economic stability seems like a distant memory. Political tensions are high across the globe. In such an environment, gold shines as a safe haven asset. It is a truly international asset, understood and accepted by all cultures as a symbol of wealth. Physical gold is exactly what it sounds like. It is real, tangible gold that you can hold in your hand. When you own physical gold, you possess a real asset with intrinsic value. This direct ownership is what many investors seek. They want something solid, something that has been valued for millennia. One of the most popular forms of physical gold is coins. Governments around the world mint gold coins. Examples include the American eagle, the Canadian maple leaf, and the South African Krugerrand. These coins are often legal tender in their country of origin. However, their true value comes from their gold content, not their face value. Coins are easy to buy, sell, and store. They are recognizable and trusted. Many investors start their gold journey with these well-known coins. For larger investments, gold bars are a common choice. Many investors start their gold journey with these well-known coins. These bars, also known as ingots or bullion, come in various sizes. They can range from small 1-gram bars to large 400-ounce bars. The main advantage of bars is that they usually have lower premiums over the spot price of gold compared to coins. Reputable refiners produce these bars. They are stamped with their weight, purity, and the refiner's mark. This ensures their authenticity and quality. For investment, focus on high-purity items, or better yet, stick to bullion coins and bars. Buying physical gold requires careful consideration. The most important step is to find a reputable dealer. There are many dealers out there, both online and in physical stores. Look for dealers with a long history and good reviews. Avoid high-pressure sales tactics or deals that seem too good to be true. Always compare prices from different dealers. The price of gold products will be the spot price of gold plus a premium. This premium covers the dealer's costs and profit. Once you own physical gold, you need to think about storage. Storing it at home in a high-quality safe is one option. This gives you direct access to your gold. However, it also comes with risks. These risks include theft, fire, or other natural disasters. If you choose home storage, make sure your insurance policy covers precious metals. For greater security, many investors choose professional storage options. Bank safety deposit boxes are a common choice. However, access is limited to bank hours, and contents are not typically insured by the bank or FDIC. Private vault facilities offer another secure option. These facilities specialize in storing precious metals and often provide insurance. Insurance for stored gold is absolutely essential. Digital gold is a relatively new way to invest in gold. It represents ownership of gold, but you do not hold the physical metal yourself. Instead, a third party, like a financial institution or a specialized company, stores the gold for you. You own a claim to that gold. This approach appeals to those who want gold exposure without the challenges of physical storage. One popular form of digital gold is gold exchange traded funds, or ETFs. These are investment funds that trade on stock exchanges just like shares of a company. Gold ETFs aim to track the price of gold. The fund holds physical gold bullion in a secure vault, managed by a custodian. When you buy shares of a gold ETF, you own a part of that underlying gold. This makes it easy to get exposure to gold price movements through a regular brokerage account. Online gold platforms have also emerged. These platforms allow you to buy, sell, and hold gold digitally. Often you can buy very small amounts of gold, even fractions of a gram. This makes gold investment accessible to people with limited capital. One of the biggest attractions of digital gold is the ease of buying and selling. You can typically invest in digital gold with just a few clicks on a computer or a smartphone app. There is no need to visit a physical dealer or arrange for secure transport. Trading can usually be done during market hours, similar to stocks. This convenience is a major draw for many modern investors. Digital gold often comes with lower transaction costs, especially for smaller investments. The bid-ask spreads for gold ETFs, for example, can be very tight. This means the difference between the buying and selling price is small. Furthermore, with digital gold, you do not have to worry about the costs and hassles of personal storage. Liquidity is another significant advantage of many digital gold products. Gold ETFs are traded on major stock exchanges and are generally very liquid. Digital gold platforms also allow for very small investment amounts. This fractional ownership makes gold accessible even to those with very modest savings. Section 6. Sovereign gold bonds, government-backed gold investment. Sovereign gold bonds, or SGBs, are a specific type of gold investment offered by some governments. The Reserve Bank of India, for example, issues SGBs on behalf of the Government of India. These bonds are denominated in grams of gold. When you invest in SGBs, you are essentially lending money to the government. In return, you get a bond whose value is linked to the price of gold. This is an alternative to holding physical gold or investing in gold ETFs. SGBs have some unique features. A key feature is that they pay a fixed rate of interest. This interest is typically paid semi-annually on the initial investment amount. This means you can earn income from your gold investment in addition to any potential capital appreciation from a rise in gold prices. In some jurisdictions like India, SGBs also offer tax benefits. For instance, capital gains on redemption at maturity might be tax-exempt. These features make them attractive to certain investors. Section 7. Physical gold versus digital gold, weighing your options. Physical gold has undeniable advantages. Its primary benefit is that it is a tangible asset. You can hold it, store it where you choose, and it is yours. If you hold it directly, there is no counterparty risk. This means its value does not depend on the solvency or honesty of another party. In times of severe crisis, when financial institutions might fail, physical gold in your possession remains valuable. However, physical gold also has its drawbacks. Storing physical gold securely can be costly and inconvenient. You need a robust safe, or you must pay for professional vaulting services. Insurance adds another layer of expense. When buying or selling physical gold, especially smaller quantities, you will pay a premium over the spot price. Digital gold, such as ETFs or online platform gold, offers significant convenience. Buying and selling can be done quickly and easily online. The entry barrier is low, allowing investments in small amounts. Storage is handled by the issuer or custodian, relieving you of that burden and direct cost. The main concern with digital gold is counterparty risk. Section 8. Gold bonds versus other gold forms, a comparative look. Sovereign gold bonds, SGBs, present a unique set of pros. The most notable is the interest income they provide. This is something neither physical gold nor most digital gold ETFs offer. You earn a fixed percentage on your initial investment, paid periodically. Another significant advantage is the government backing. This implies a lower risk of default on the principal and interest payments, at least in the eyes of domestic investors. Despite these benefits, SGBs also have their cons. They typically come with a lock-in period. For example, Indian SGBs have a tenure of 8 years, though early redemption or trading on exchanges is sometimes possible after a few years. This makes them less liquid than gold ETFs, which can be bought and sold daily. The interest earned on SGBs is usually taxable as income. While backed by the government, this also means your investment is tied to that government's fiscal health and promises, which is still a form of counterparty risk. Section 9. Smart gold investing. Key takeaways for your financial future. The first principle of smart investing, including in gold, is diversification. Gold should be considered as one component of a well-balanced investment portfolio. It should not be your only investment. Spreading your investments across different asset classes helps to manage risk. Gold often behaves differently from stocks and bonds, especially during economic uncertainty. This can make it a valuable tool for portfolio stabilization. Consider your overall financial picture. Before investing in any form of gold, it is crucial to understand your personal financial goals. Are you primarily looking to hedge against inflation and currency devaluation? Are you seeking long-term wealth preservation, or are you perhaps speculating on short-term price movements? Your objectives will significantly influence which type of gold investment is most suitable for you. Always do your homework. Thorough research is essential before committing your hard-earned money. Ultimately, my strong preference has always been for physical gold.